Welcome to the Pump and Dump channel. Today I want to talk about debt and inflation and how corporate debt will ultimately lead to inflation. Now a lot of people, like Austrian School of Economics people, they will say that inflation is caused by the central bank printing money and pumping it into the system. And of course it always comes down to what your definition is. They define it solely as creating more money and pumping it into the system. But then we have other definitions like the more mainstream one that inflation is a general level of increase, or an increase in the general level of pricing. So what of course people, feel in their pocket is when prices of goods go up, and that's what they feel is inflation, more dollars chasing fewer goods. Some people will say that, oh well, the money printing is going into financial assets and it's not, hitting into the economy, and because the people who have financial assets are wealthy and their demand does not necessarily increase, it makes perfect sense that the inflation it's caused is not going to lead to higher prices in the economy. Now, of course, the central banks, they look at those metrics, what the general price levels of goods is, and they want to cause inflation by doing what they are doing. And of course, it makes, if you look at it critically, and like I said, you look at where the money is going, it's going to financial assets and then to people who don't need to, get money to spend on more goods. So what really is happening is that we won't see inflation coming from that, that point of view. Now some people are saying modern monetary theory says give the people the money so they can spend it into the economy, but from what the central bank, the ECB, said in the last meeting, that's not up to them to put money in the hands of people. That's more of a fiscal thing that governments should give money into the hands of the people. And I remember in the US they had also under Obama where, like, I think you could get like $600 as a stimulus, or some nonsense about getting some money for free. And yeah, that kind of was supposed to get economic growth going again and inflation. But of course in the long term we can see that the money printing and the stimulus, it has not led to sustained increases in price levels, and everyone's asking themselves why are prices not going up. And you can say that prices are up. You can say that, like, if you look at what the ECB announced just the other day, they talked about putting in 20 billion euros of money every month for an unlimited period of time into the system through asset purchases. If we look at the gold price, it's at 1488. Just 2 days after the announcement, we can see that it's nowhere near its 1550 level, which was the technical resistance. Of course, in one of my previous videos I talked about how that was the 1550 level was a 50% margin on the 1000 to 1100 or so all-in sustaining costs at that point in time, and therefore it made perfect sense for it to pull back. And you could say the gold price over this year ran up, assuming that the ECB would be doing some more money printing, and that you could say that was people buying the rumor and now selling the news. They already sold it a few days before the ECB announcement, as of course in people's perception, like they only look at what's going to happen next week or tomorrow, and as things comes closer, it becomes more visible, and then people start seeing the story, and then they think, oh, the inflation's going to come, so they get in at this point in time. And of course that's when the people who have been preparing for the trade down here are selling into them. So yeah, then there's also the bond situation. In my video about the mortgage, I talked about how negative interest rates were unsustainable in the long term because it made no sense that people could reinvest money into securities that paid them back less and keep doing that forever. We can see here the German bond, it was about 107 or so, and now it's at 104.57. The negative yield at that time, it's like a week or so ago, it was at 0.7% negative, and now it's at 0.45% negative. The German 30-year bond was also negative at that point, had a price of 102, and now it's down at 96. So you actually get a return over 30 years of €3.85 on 96.15 that you pay, which gives you an annual return of 0.12%. So of course, the people who were saying, I saw some people who were saying that these negative interest rates were going to stay with us longer than we think, and I just don't buy it. For me, it makes no sense that this is sustainable. So getting back to the topic of how debt will lead to inflation, we have seen in the last couple of years a lot of companies loading up on debt because it's the most accretive way to create shareholder value, is load up on debt at a very low cost, because the cost of equity is usually higher than the cost of debt. And that has been driving their financial performance higher, and they've been doing okay. And as long as the interest rates stay low and they can refinance their debt at low rates, that should be okay for them. So why am I saying that these corporate debts in the long term will cause inflation? We can also take another example before we go into that, of private equity. What they do is they go into companies, they buy them up, and then they load them up with debt. They substitute the equity for debt. They leave a capital structure that is highly indebted, very leveraged, and then they take out the money. That's kind of the financial engineering that we see in our system, where people are gaming the system to avoid working but having lots of money. And the way it is that when they load up these companies with debt and substitute the equity for debt, they put the companies into this position where they not only have to pay interest on the debt, but they have to repay the principal amount at maturity. And with equity, it's very different. With equity, you raise the equity, you can say that you intend to pay a dividend depending on performance. Whether the performance is good or not, in the end you can pay a dividend, but you're not obliged to. You don't have to return the capital. It's like when you make an equity investment, it's assumed that it's forever, and the companies who take the money, they know this, and the CEOs, they want to see the share price rise over a certain period of time, whilst they're in office, so they can get their bonus. But ultimately, whether there is a return to equity holders or not doesn't matter. Companies will always try and compete with each other, and when they are loaded up with money from equity, they will use that as a weapon to compete on pricing and take market share, with the hope and expectation that in the long term it will lead to a better financial performance. So getting back to this video, Ronald Reagan here in 81, he's talking in his address to the nation about how taxes is leading to inflation. And in one of the videos I remember seeing when I was a child in the documentary, he talked about how debt was the #1 driver of inflation. And I remember hearing that, and it kind of stuck with me, and I never forgot it, even though it's probably like 20 years ago since I watched that documentary. But in this video here, he talks about how taxes leads to inflation, and afterwards we can then talk about how we can substitute tax with debt, and the interest being the cost of servicing the tax, not the tax, the debt is the cost that's being passed on to the consumer, just like the tax. So I just have Ronald Reagan assist me here. He's passed away 15 years ago, but we still have this from the archives. So I'm gonna give the word to Ronald and let him tell us how it is.
Some say shift the tax burden to business and industry, but business doesn't pay taxes. Oh, don't get the wrong idea. Business is being taxed so much so that we're being priced out of the world market. But business must pass its costs of operations, and that includes taxes, on to the customer in the price of the product. Only people pay taxes, all the taxes. Government just uses business in a kind of sneaky way to help collect the taxes. They're hidden in the price. We aren't aware of how much tax we actually pay.
So there we go. If we just look at the debt situation, the companies are loaded up with debt. It just takes some catalyst to raise interest rates to a normal level or to a higher level. It could be something like a bankruptcy of a major corporation. Not going to go into names because I don't want to name a company that's got a high debt load and say that they're destined to go bankrupt because of it. It's not necessarily that it will go that way. But we can just think about it intellectually. Some companies will go belly up because the industries they are in are going to like experience less interest by consumer and less spending by consumers, and if their debt load is getting too high and they cannot service it, they will go belly up, especially in these private equity deals where it's really highly leveraged, and it really needs um, the business plan to work 100% to perfection to survive. So of course when that catalyst happens, you know banks will ask themselves like whether it's rational to lend money to any corporation at 1% or 2%, whether they should be more stringent and ask higher rates. And at that point in time, of course, the companies who are loaded up with debt and have like an EBITDA to debt ratio of about, or debt to EBITDA ratio of about, say, I don't know, let's say 10 or 7, who cannot repay their debts, within a short period of time, they are always going to have to renew their debt obligations and refinance with a new bond. And when the interest rates go up, they're just going to have to eat it. And that's kind of where the inflation will come from, because in a situation where very much like a very high percentage of the companies who are large caps are loaded up with debt because of the easy money policy over the last years, giving them that low interest rates, and they have to create shareholder value for their shareholders. They are going to be in this situation where they have to raise prices, and if there are enough of them and you are in a situation where the supply side of the economy is loaded up with debt and needs to raise prices, the consumers will have no choice but to pay, or have to ration what they buy with other companies. And that of course is not sustainable, because then people lose their jobs at those companies that are highly leveraged up with debt, and then you have this circle where everything collapses. So ultimately what it comes down to is that when interest rates rise and these loans are or bonds are maturing and need to be refinanced, it will lead to an increase in prices. And I can just do a quick explanation in Paint of how this conceptually works, just to simplify it. We can think of this line being the price line and this line being the cost, and down here we'll have theoretical zero. And this point here between the price and the cost is of course the margin that businesses earn over the long term. For businesses to survive, they usually have a certain percentage in terms of the margin they earn, whether it's 30% or 20 or 50, it doesn't really matter. Let's just take 50% for this example. Let's say the cost is $1 per unit and the price is $2 per unit, and the margin therefore is $1, and that feeds through to the earnings that goes to the investors. Like earnings per share is in a certain number, and what happens in a a deflationary cycle like we are experiencing right now with like in the US, you have the tax cuts by Trump that were put in place, which have lowered costs. I remember a lot of companies were against that. They they gave the savings that they estimated they would get from that, they turned that into a bonus for their employees, because they're not because they want to stimulate the economy, but because they wanted to defend the cost line. They want that costs to stay up. The same happens when interest rates fall, the costs come down, and because the margin, let's say at 50%, will hold over the long term, the prices come down. If we just look at it conceptually, the cost, let's say they go down from $1 to 75 cents per unit, the competitive nature of industry will lead to price levels coming down to, let's say, $1.50, and then this margin that was previously $1 will fall to 75 cents. Now, of course, this is not good for shareholders, because then their return on equity is lower, their earnings per share drop, and therefore businesses, they don't like when their cost structure goes down, even though they come up with cost saving initiatives. But really what they want to see is their cost structure rise, because that drives the price levels up to maintain this margin, and that drives up the absolute number in terms of what they earn, and therefore the earnings per share rise, and therefore the stock price will rise. Of course, when it goes down the other way, stock price goes down. They don't like that. So once interest rates rise, like I said, the of course taxes being low with a Republican president will lead to the same effect. Costs are down. We have this inflation. Until interest rates rise or the tax policies are reversed, we won't see inflation as most people feel it in terms of the general price level that we see in the store. So I'm going to leave it with that. You can leave a comment if you agree, disagree, or want to add something in the comment section. You can subscribe if you want to be notified whenever I put out a video in the future, and have a good day.